So in this video, I'd like to share with you 5 main option strategies that I believe every option trader or investor should at least know about. Whether you choose to employ these strategies or not, it's really up to you depending on your trading style, your goals, the way you like to trade. But at least if you have some insight behind these option strategies, you'll be able to be more flexible during different market conditions or during different conditions of the stock. So for some people, if they only employ one of the strategies and that is the strategies you stick with, you may not be as active of a trader because certain strategies may be better suited during different times of the market. But of course, if you know and understand a few different strategies, it'll allow you to become flexible. So in this video, I'd like to share with you the 5 main strategies that I think everyone should at least know about, or at least get some insight about, so that way you're able to be a little more flexible when it comes to trading options. And of course, these are just the root basic option strategies. You can go into more complicated option strategies as you evolve. You can get into some other things like gamma scalping and really just more in-depth options as you start taking the educational level deeper or higher to that next level. But if we're just getting started, let's talk about the 5 main option strategies. Now, the first option strategy is simply covered call option strategy. Now, usually the covered call option strategies is employed or used when you have some stock. You already have some stock in a long position, so you're already looking for that stock to go higher. However, for the short-term view, you believe that stock is going to consolidate or move sideways or may not move that fast to the upside. So what you can do is sell some options premium, such as selling a call a little bit further, a little bit higher. This allows you to collect some premium from the option and still hold your stock. Now, if the stock does continue to move higher towards your call price and it hits it, it is quite possible that you will lose your stock if somebody chooses to exercise their option rights. But in general, if the stock stands still, you'll collect option premium and you'll still have your stock. So you do need to understand the upside and the downside. So covered call writing is the first option strategy that a lot of beginners and people that are just getting into options start with after buying and selling stock. The second option strategy is a bullish or bearish vertical spread. So what a vertical spread is it's basically a directional play in the stock. So you can either look at the stock for it to go higher if you're doing a bullish vertical spread, or actually lower if you're doing a bearish vertical spread. So what this does is allows you to buy a call and sell a call at different price ranges, and it allows you to capitalize as that stock moves further. Now, in the put side, you can do the same thing, and this would help create your bearish vertical call. But basically, you're looking for a directional play in the stock. It allows you to use less capital and less premium in terms of moving that stock or profiting from the stock movement. But there is a downside risk, of course, because if you don't get that stock to move in a certain time period, then you will lose your premium depending on how long you hold on to it. If you manage to get out of the position before the option expires, then you'll collect some of that premium back. However, if you hold on to it all the way until expiration and the stock didn't move, then you will lose out your premium or your capital that you used to invest in that vertical spread. The third option strategy is a butterfly, and a butterfly is very flexible. And the reason it's called a butterfly is kind of looks like a butterfly. It has some wings on the end, but really what happens with the butterfly is you're selling 2 option contracts right there in the center or in the middle of your spread, and you have 2 protective option contracts on the other side. So what you're doing is you're buying one on one end, one on the other for protective reasons, and then you're selling 2 in the middle. So what happens is as time decays and the stock doesn't move, you're collecting that option premium as the stock price is shifting in between these price levels. Now you can also put on directional based butterflies, so you can put it a little bit further out to the bullish side or to the bearish side if you're looking for a price movement or a little bit of movement in the stock, either to the upside or to the downside. But this option strategy is really good in terms of collecting premium. It's a fast premium collective strategy just because you have two option contracts concentrated right there in that center of that butterfly looking spread. The fourth option strategy is called a calendar. And what a calendar is basically you're trying to capitalize again from option deterioration. Now, it looks similar to a butterfly, but the difference between the butterfly and the calendar is that the calendar is usually offset in terms of buying and selling your options in separate months. Whereas the butterfly, all of your contracts are in one single month. So the Vegas are going to be different, and there's those advantages and disadvantages that we don't have time to get into in this video. But with a calendar, what happens is typically as options deteriorate, they deteriorate the most towards that last 30 days before the whole contract is worthless. Now, with a calendar spread, what happens is you're selling an option contract in the front month or the closest month, and you're buying one for protection in a later month. So that means the earlier month contract expires quicker, but then the later one expires a little bit slower. So because the expiration curves are a little different, you're capitalizing and gaining that premium every single day as the option contracts deteriorate quicker in that first month that you're approaching and coming into, rather than the later months that you've bought protection in, because you have much more time premium associated with those option contracts. So the thing with the calendar spread is you need to always be cautious with the Vegas. And of course, you can also put these spreads on a little bit more bullish or a little bit more bearish, similar to the butterfly spread. And finally, the fifth strategy that many option traders should know about is the iron condor. And the iron condor is basically the selling of two vertical spreads on both sides, where you're looking to capitalize again from deterioration of option premium. So if you sell a vertical on one side, on the put side, and one on the also on the call side, now this creates a spread, kind of like a little box shape rectangle, and as time it moves forward, this premium deteriorates, and as it deteriorates on both sides, since price cannot be at two places at once, you collect premium as things expire. Now, of course, if prices do run against you, you do have to adjust this spread and maybe take off one side, maybe shift one side, roll one side, maybe buying a put. There's a few different strategies that you can employ, but basically that is your last and final strategy that I think many beginning option traders should at least know about in the direction of where their learning should move. So there you go. If you enjoyed this video and you want to continue learning with me, click one of the thumbnails right below this video and we'll continue learning together. And if you want to see some of my more in-depth video training lessons about the stock market and some of the stocks that I'm watching today in the current market conditions, then click this link right up here and enter your name and email address when you get there. And don't forget to check out some of my other video training courses while you're there. Thanks again, and remember to do what you love, contribute to others, but most importantly, live life abundantly. I'll see you next time.